In May, Japanese investors sold 2.72 trillion yen of foreign stock, about $17 billion, the largest single month of foreign stock selling Japan has done since April of 2021. And it came out of Japan's own Ministry of Finance in a spreadsheet they publish every month that almost nobody in American financial media opened. Here's the part that should make you sit up. It wasn't retail investors. It wasn't a hedge fund taking profits. Break it apart, and one category did the selling: trust accounts. That's the pension money, the capital that manages retirement for the country of Japan. They pulled 3.38 trillion yen out of foreign stocks in a single month and moved 3.16 trillion into bonds. 12 days later, Japan's finance minister stood up and said this, out loud, on the record. We really hope that pension funds, as well as individuals, will invest more in domestic assets. Now, if you've watched enough of these, your brain just filed that under Japan's debt problem. Everybody covers Japan's debt. Fine. That is not this story. And everyone arguing about the bond auction is watching the wrong door. Because there's a number in a United States Treasury survey, published once a year, buried in a PDF, and I actually read the thing, that reframes this entirely. In 2009, 23% of what foreigners held in America was stock. The rest was mostly debt. Today, that number is 56%. 56%. The world did not buy America's debt. The world bought America's stock market. And the bid underneath the account you're planning to retire on is, to a degree almost nobody has priced, foreign. So when a finance ministry on the other side of the planet asks its pension money to come home, that is not a Japan story. It's a story about who has been standing under your market with their hand up, and what happens the day they put it down. I'll walk you through the whole chain. Who owns your market, why Tokyo has no choice, what it did the last time this happened, what the system does when it breaks, because that playbook already changed and there are receipts, and what happened to Bitcoin in the middle of it, which is the part that changes everything. And I'll keep one thread running underneath all of it, because Japan already ran this experiment. Not a version of it, the whole thing, 30 years, start to finish. What a country gets at the end of that road is not what anybody predicted. Quick thing, then straight back. If you're new here, this is the channel that reads the actual documents. The Treasury Survey, the Ministry of Finance spreadsheet, the Central Bank report. Not the headline written by somebody who didn't open them. If that's useful, hit subscribe. Japan's next flow numbers land in a few weeks, and I'll be on it. Now, who actually owns your market? Let's do the ownership question properly. As of the Treasury's last full benchmark survey, foreigners held about $35 trillion of American securities. Of that, 19.86 trillion is equity. Stock. Ownership of American companies. Japan's slice is $1.169 trillion of US stocks. Add its treasuries, its agency debt, and its corporate bonds, and Japan is sitting on $2.88 trillion of American paper. Fourth largest in the world. And let me be straight, because somebody will pull up the table. On the raw list, Japan ranks 6th, behind the Cayman Islands, Ireland, and Luxembourg. Those aren't Cayman Islanders buying Apple. Those are fund addresses, where the paperwork lives. Treasury says so in the report itself. Strip out the mailboxes, and Japan sits at the top of the list of actual countries. Worldwide, Japan holds about $2.48 trillion of other people's stock markets. One country. Here's the piece with a name and a phone number. Japan's Government Pension Investment Fund, the GPIF. The largest pension fund on Earth, about $1.81 trillion, running a deliberately simple recipe. 25% each. Domestic bonds, domestic stocks, foreign bonds, foreign stocks. Which means roughly half the retirement savings of Japan is invested outside Japan. 460 billion of it is foreign stock, and 232 billion sits in US Treasuries. And here's the number to hold on to, because everything downstream runs on it. 1 percentage point of the GPIF is about $18 billion. 1 point. Not a revolution, not a fire sale. 1% of one fund, $18 billion of buying or selling. Think about what a market actually is. The price of a stock isn't set by the millions of people holding it. It's set by the last buyer and the last seller, the marginal bid. It's like your street. Nobody reappraises the whole neighborhood. One house sells, and that sale prices every other house on the block. Foreign institutions have been a large, patient, price-insensitive part of that marginal bid for 2 decades. They weren't trading, they were allocating. Every month, on schedule, buy the foreign sleeve. When that changes, it doesn't change because somebody panicked. It changes because a committee updated a spreadsheet. And your savings get repriced by a spreadsheet you've never seen, in a language you don't read, on behalf of retirees you'll never meet. Bitcoin has no marginal foreign allocator. There is no committee anywhere on Earth sitting on a Bitcoin sleeve it can vote to bring home. So what actually happened? On July 10th, Japan's finance minister, Satsuki Katayama, said she wants pension funds and individuals investing more in Japanese assets. Days later, she put it formally. She wants to encourage pension funds, including GPIF, to make substantially greater investments in Japanese financial assets. And she added something people skipped right over. This is not something I can decide on my own. That sounds like a limitation. In markets, it's the opposite. Because the GPIF only resets its allocation on a 5-year cycle, and the next review isn't until 2030. So on paper, nothing is changing. But every insurance company, every bank, every trust manager in Japan just watched the finance ministry say where it wants the money. And none of them are on a 5-year cycle. They can move Monday. That's how this works. Nobody orders anything. The signal goes out, and 1,000 institutions quietly stop rolling their foreign positions. And this matters, because I'd rather you hear the weak part from me than find it in 3 weeks. The exodus has not started yet. Here are the honest numbers. They sold foreign stock hard in April and May, but they bought hard in the first quarter, over 2 trillion yen in March alone. Added up, and for the first half of 2026, they're net buyers by about 59 billion yen. That's flat. And in the 5 most recent weekly reports, they were net buyers 4 weeks out of 5. So anyone telling you the money is fleeing right now is running ahead of the data. That's not a reason to look away, it's the reason to look now. Because May was a rehearsal. 1 month, the pension money moved $17 billion out of foreign stock into bonds, and its own government said, "More of that, please." Where the selling is already sustained is bonds. Japanese investors have sold nearly 3 trillion yen of foreign debt this year. That leg is real and continuous, and it's exactly the pattern you'd expect. First, bonds move before equities, because bonds mature and equities don't. You don't have to sell a bond, you just have to not buy the next one. And every month they don't, somebody else has to, at a higher yield. That's your mortgage, your bond fund, and the interest bill on $39 trillion of federal debt, a bill that in the end gets paid by the printer, which is the entire reason a fixed supply asset like Bitcoin exists. You might wonder why Japan would do this to its own returns. Half their portfolio has been offshore for a reason. It made money. So why break it? Because the currency is coming apart and they've run out of other tools. As I'm building this, the yen is around 163 to the dollar, the weakest since 1986. Ronald Reagan was president the last time the yen was here, and Japan fought it hard. Between late April and late May, the Ministry of Finance spent 11.7 trillion yen, about $73.6 billion, buying its own currency on the open market. Largest intervention since 1991. It worked for about 3 weeks. The yen bounced 2.6%, then kept falling. And from late May through late June, Japan intervened exactly 0 times. $73 billion for a bounce that didn't hold, and then silence. JP Morgan's head of currency research put it about as bluntly as a bank ever does. The defense line the market assumed was there, quote, has effectively disappeared. Here's the trap, and it's worth understanding because we're walking toward a version of it. Leave rates at zero, and your debt stays cheap while your currency dies. Japan imports almost all its energy and pays for it in dollars. So every barrel and every chip gets more expensive. That's a tax on every saver in the country, collected monthly, forever. Raise rates to save the currency, and the cheapest debt in the developed world stops being cheap. Against the heaviest debt load on the planet, 206.5% of GDP, per the IMF. Every tick on a pile that size is real money. Japan tried threading it. They raised to 1% in June, the highest since 1995, and intervened at record scale. They got the worst of both. The currency kept sliding, and long-term yields kept climbing. It's like tapping the brakes with your other foot on the gas. You burn the pads, and the car doesn't stop. So there's one lever left, and it doesn't cost a yen. You don't have to buy your currency if you can convince the money that already belongs to you to come home and buy it for you. That's the cheapest intervention there is, and it works by taking the bid out from under somebody else's market. It also tells you something permanent. A currency that can be asked to come home is a currency somebody manages. Bitcoin has no home to be called back to, and nobody to do the asking. If you want to know what this looks like when it moves, you don't have to imagine it. We have the tape. August 5th, 2024. 6 days earlier, the Bank of Japan raised rates by 25 basis points, 1/4%. And at the time, the gap between American and Japanese rates was over 5 full percentage points. So a quarter point should have been a rounding error. Here's what a rounding error did. The yen went from about 162 to 142, 12.5% in under 4 weeks. The Nikkei fell 12.4% in one day, the worst percentage day in Japan since the crash of 1987. 113 trillion yen, $792 billion, gone from Japanese stocks. And it did not stay in Japan. The Nasdaq fell 3.4% that Monday, and from its July high, it was down 15.7%. The VIX, the fear index, spiked to 65.73 intraday, the highest since March of 2020. The CBOE, which runs the VIX, files that event under a label. They call it the yen carry unwind. And Bitcoin fell 30%, from over $70,000 down to $49,000. Van Eck wrote the postmortem, and their exact words matter because they're not a crypto blog. The crash to 49,000 followed, quote, a risk-off typhoon spawned by the yen carry trade. Sit with that, because it cuts against what you'd expect me to say. Bitcoin went down, hard, faster than stocks. I'm not going to hide that. When leverage unwinds, everything with a margin call attached gets sold. And Bitcoin is the most liquid thing on most of those books, so it goes first. That's not a flaw in Bitcoin. That's a fact about the people holding it. And there's a measurement behind it. Someone ran the correlation between the yen and the Nasdaq on down days. Days the index falls more than 1.5%. In 2022 and 2023, basically zero. In 2024 and 2025, negative 35%. The yen has quietly become the fear gauge for American technology stocks. Here's the half people forget. It all came back. The Nikkei rose 9.4% the next day. The S&P recovered everything by August 9th. It wasn't a crisis. It was a stress test. About 5 hours of genuine panic, and then the machine reset. So compare the setup. Then the rate gap was over 500 basis points, and a 25-point move did all of that. Now the gap is 250 to 300, half as wide, which means the cushion is half as thick. The yen is at a 40-year low. The Bank of Japan is at 1% and climbing, not at zero. And Tokyo just spent a record 73 billion finding out its line in the sand isn't there. Goldman Sachs said this month that carry trades are, in their words, bigger than they have been in many years. The most compelling setup in more than 2 decades. Bigger position, thinner cushion, same trapdoor. One sentence and I'll move on. Everything I just walked you through, the numbers, the sources, the receipts, I write up every week in a free email called The Macro Signal. It's on the front page at timtalksfinance.com. One box, just your email. There's a second channel here, and it turns a currency move into a credit event. Japanese banks are enormous cross-border lenders, and the Bank of Japan publishes what those foreign loan books are made of. The single biggest category, 29.2% of major Japanese banks' foreign loans, is lending to non-bank financial institutions. That's the polite term. It means funds, vehicles, the leveraged plumbing. The Bank for International Settlements says the same about the whole world. Banks' cross-border claims on non-bank financials went from 7% of all cross-border lending in 2015 to 24% in 2025. The risk moved off regulated balance sheets into structures where, by the BIS's own admission, the data doesn't really exist. And it's already tightening. The BIS's latest numbers show yen-denominated credit outside Japan contracted 4.9% during 2025. Not projected, already happened. Now the other side, because a story that shows you one side isn't worth your time. Right now, nothing is broken. The Bank of Japan's April report says dollar funding premiums are generally at low levels. The IMF says funding spreads have remained broadly stable thus far. I won't tell you there's a fire when the smoke detectors say there isn't. That is the point. This is the setup, not the event. The time to understand a mechanism is while it's quiet, because when it isn't quiet, you won't have 25 minutes to think. You'll have about 5 hours. We measured it. And notice which asset here has no pipe running into it. Bitcoin doesn't borrow yen. No credit line, no counterparty, no lender who can decline to roll it. Leveraged holders get margin called, but nothing can be withdrawn from Bitcoin itself. Now, the thread I've been holding since the beginning. Japan already ran this experiment. All of it. 30 years of zero rates. A central bank that bought its own government's debt on a scale nobody had ever attempted. And here's the thing almost nobody knows about Japan. Japan was the disciplined one. Since January of 2004, the American money supply, M2, grew 281%. Canada's grew 368%. Japan's grew 89.7%. I checked all three against the primary data. America nearly tripled its money. Canada nearly quadrupled it. Japan didn't quite double it in 22 years. By the only measure most people know, Japan was the most restrained major economy on Earth. So if a country runs the tightest money in the developed world for 2 decades, what does it get? It gets this. The Bank of Japan's balance sheet grew 465% over the same period. Read that against the last number. The money supply grew 90. The central bank grew 465. Canada's entire money supply grew 368. Japan's central bank grew more than Canada's money supply did. The Bank of Japan now owns 43.1% of all Japanese government debt. Nearly half the national debt is held by an institution that created the money to buy it. And the money multiplier, how much money the banking system creates per unit the central bank makes, collapsed from about 6 to about 2.3. So Japan's 90% wasn't discipline. It was a machine that stopped working. They printed as hard as anybody. The money never made it out of the central bank's basement. That's a pipe with a clog in it. Less water reached your house, but that doesn't mean less was pumped. And now the payoff. The Bank for International Settlements publishes a real effective exchange rate. It's the honest version of a currency's value. What it actually buys, adjusted for inflation. Not the headline on a screen, the purchasing power. Japan's is at 62.26, the lowest reading since before 1972, lower than any month in about 59 years. The yen buys less in the world today than it did before Bretton Woods collapsed, before the oil shocks, before Japan was Japan. Since 2004, the yen has lost exactly half of its real purchasing power. Half. And here's the detail that closes the case. That real decline almost precisely matches the nominal decline against the dollar, about 52% both ways. Japan got the currency destruction without the printing benefit. The purchasing power they saved by not printing went anyway. So let me say it plainly. Japan tried every exit. 30 years of zero rates, a central bank that bought half its own debt, the most restrained money supply in the developed world. And at the end of that road, a currency at a 60-year low in real terms, the highest debt ratio on the planet, and a finance ministry asking its own pension fund to please come home. Japan is not the country that found a way out. Japan is the proof that there isn't one, not inside the system. 30 years of the most careful monetary policy on earth, and the saver still got robbed. That is the case for Bitcoin, made by a country that never mentioned it, which is why the exit has to be something the system doesn't issue. And there is exactly one asset like that, Bitcoin. Now let me tell you what I actually think happens, and be clear that this part is my read of the evidence, not a fact I can hand you. I don't think this ends in a permanent crash. I think you get a violent shock, shorter than people expect, and then I think it gets caught, because the tool for catching it is already built, and it isn't the one from 2008. In 2008, the government lent. TARP put out $443 billion and got most of it back. The bank equity piece made $16 billion. That's not the model anymore. Now it buys. Since January of 2025, the United States government has taken $26.7 billion of equity across 30 deals. Intel, $8.9 billion for 9.9% of the company, paid for by converting CHIPS Act grants that hadn't been handed over yet. No new appropriation. That stake is now worth about $42 billion. The paper gain on that one position is larger than the entire lifetime cost of TARP. But Intel isn't the template. MP Materials is. The Defense Department took about 15%, making it the largest shareholder. And bundled into the same deal? A guaranteed price floor of $110 a kilogram for 10 years, when the market was around 60. A commitment to buy 100% of the output for 10 years. And a guaranteed minimum of $140 million a year in earnings. Read that again. The government took the equity, then guaranteed the revenue that makes the equity worth something. Or Trilogy Metals, where the government's warrants strike at 1 cent a share and only vest once a specific road gets built. The same road, the same government committed to help finance and fast track through permitting. Investor and regulator, same desk, same project. Or Nvidia and AMD, where there's no equity at all. Just 15% of China chip revenue paid to the government in exchange for the export license, later raised to 25. The payment is the permission. Across the 9 publicly traded companies in this portfolio, the average share price gain was 85%. And there is no ledger. Fortune went looking last week. These stakes appear in no unified budget document anywhere. The sovereign wealth fund meant to hold it was ordered by executive order in February of 2025 and still does not exist. Now the part that sharpens it. In April, Spirit Airlines asked for exactly this deal. $500 million, and the government could have an overwhelming majority of the shares. They were told no. No funding source, no emergency authority, political backlash. Spirit stopped flying on May 1st. So the rescue is real, and the rescue is selective. If you're deemed strategic, you get equity, a price floor, an offtake, and a permit. If you're a budget airline, you get liquidated. That's the world on the other side of the shock. The strong get recapitalized with newly directed money and a government customer. The weak get cleared out. And asset prices come back higher because the thing that rescued them was more money. More money chasing the same assets. Which is the entire argument for owning the one asset more of which cannot be made. There are 21 million Bitcoin. A rescue package cannot mint the 21 million and first. Step back and look at what all of this has in common. Japan's pension money can be asked to come home because it lives inside a legal system with a finance ministry attached. Your treasuries are an entry in a ledger the treasury keeps. Your stocks are almost certainly held in street name, a claim on a broker's book, inside a clearing system. Your house has a registry at the county, a lien holder, and a tax bill. Your dollars are a liability of an institution that voted this week on what they're worth. Every asset you own is an entry on somebody's ledger, and every ledger sits inside a jurisdiction with somebody who can change its rules. Usually they don't. This month, Tokyo showed you they can, and they didn't need force. Just a sentence from a finance minister and a tax rate. And notice what Japan did the very next week. They reclassified crypto as a financial asset and put the tax rate on a path from 55% down to 20%. Not because somebody in Tokyo loves Bitcoin, because money that's offshore and untaxed comes home if you give it a reason, and they'd rather it land where they can see it. That's tokenization arriving as policy. They will tokenize everything: bonds, funds, equities, eventually the houses. And when every asset on Earth is a token on a digital rail, one question survives all of it. Which one has no issuer? A tokenized bond has a government that can issue more. A tokenized fund has a manager. A stablecoin has a company. A central bank's digital currency has a committee and a switch. Every one of them still has a man who can make more, and a ledger somebody else keeps. Bitcoin has no man. 21 million. Fixed. Forever. No servers, only a protocol. There is no Bitcoin finance ministry to ask it to come home, because it was never anywhere. There is no auction Bitcoin can stop showing up to. There is no registry to retitle, no committee to vote, no allocation review in 2030. You cannot repatriate Bitcoin because Bitcoin has no country. That is the entire argument. And every one of these stories, Japan, the yen, the pension fund, the intervention, the equity stakes, keeps walking to the same door, and the door keeps having Bitcoin on the other side of it. Let me close on the thing that actually changes how you look at all of it, because I think it's the piece most people never make the jump to. We measure everything in dollars. Your house went up, the market went up. And because the ruler is the dollar, and the dollar is the thing being diluted, the ruler gets shorter every year, and everything looks like it's growing. So change the ruler. Fidelity's digital asset group published this a few weeks ago, and their analysts said it better than I could. What appears to be appreciation in housing is more accurately a reflection of an erosion of fiat currency. Here's the arithmetic. Mine, not theirs. The median existing American home sold for $440,600 in June. Bitcoin is about $64,300. Divide one by the other. The median American house costs about 7 Bitcoin today. In 2020, that same median house cost more than 50. Same house, same roof, same driveway, same school district. In dollars, it went up. Priced in Bitcoin, it fell roughly 90%. And gold says the same thing, which is how you know it isn't a story Bitcoin people tell themselves. Priced in gold, the S&P 500 has gone essentially nowhere since 2006, and housing is nearly unchanged over 20 years. 2 decades of growth that was mostly the ruler shrinking. Gold caught the theft. Bitcoin measures it more sharply because gold still needs a vault, a custodian, and somebody's word. Now the uncomfortable part, because you'd find it anyway. Bitcoin is down about 45% over the last 12 months. If you bought at the top last October, you are underwater, and I won't pretend otherwise. So the honest frame is the long one. Over 5 and 6 years, the direction is unmistakable. Over 12 months, it's ugly. Both are true, and anyone telling you only the first is selling you something. And there are no certainties here, only probabilities. But here's the probability I'd ask you to sit with. Japan spent 30 years proving there is no exit inside the system. Tokyo just demonstrated that money living inside a jurisdiction can be called home with a sentence. Washington has demonstrated that when something strategic breaks, the rescue is newly created money, an equity stake, and a guaranteed customer. Every one of those roads ends the same way. More units of currency chasing the same assets. There are 21 million Bitcoin. There will never be 21,000,001. No ministry, no committee, no allocation review, no emergency authority, no executive order changes that number. It is the only line in this entire video that nobody can move. I'm not telling you to do anything. I've never done that. Your situation isn't mine. But I've handed you the mechanism and the math, and I think you can see the door from here. And if you want the picture I've been describing on one screen, that's what I built the macro command center for. That one's at timtalksfinance.com/members. Free, no credit card, about 2 minutes. You get the live macro numbers I use, the money quiz that shows you in dollars what this is costing your cash every year, and one move worth considering. Full package members can load their actual holdings and watch them priced right next to all of it. I built it so you don't have to figure this out alone. The pension money moved $17 billion in 1 month, and the government that manages it asked for more. That was the practice run. When it stops being a practice run, every asset in this video gets repriced by somebody, except one. There are still 21 million Bitcoin, and there always will be. I'll see you on the next one.